His year-end price target for the S&P at 45.75, and he joins us now to explain his strategy. Sam, welcome.
Hey, Kelly, good to talk to you.
You too. People, most of all, I mean, in a year in which a lot of the analysts are pretty bearish, people's main question is, how do you get there?
Well, first off, I think you really should understand that a target price is more of a weather vane than a laser beam. It is a 12-month outlook, and we put it together so that it gives guidance to our analysts so that when they compute the intrinsic value of underlying stocks, they know whether to make it a buy, hold, or sell based on the forecast for the overall market. What goes into that decision is a combination of fundamentals, which is the cap-weighted target price for the companies in the S&P 500 put together by CFRA equity analysts, which is a year ahead outlook. From a technical perspective, I look at point and figure targets for the companies in the benchmark. And then I also take a look at the historical precedent, because a lot of people like to forecast recency and are thinking that 2022 is going to be exactly like 2022. So the thought is, no, that's usually not the case. The market tends to rise by more than 14% following a down year versus a more normal 9% advance. And as Bob Pisani just posted recently, the January barometer is another indicator developed by the Stock Traders Almanac that points to a favorable position ahead.
Yeah, it's fascinating, Sam, because people would go, well, wait a minute, if you base this price target off the equity analysts, aren't they wrong and aren't they too optimistic and so on and so forth? But if you say, well, you know, just thinking back through history here and what we're likely to see, it's probably not going to be as bad as last year. Okay, what if we're going into recession? And I think your data points as well on what happens between the last rate hike and the first rate cut are quite provocative. It's typically a period in which stocks do quite well, and that could be the kind of period we're in right now.
Absolutely. We've had 9 bear markets since World War II that have been accompanied by recession. And traditionally, about 4 of those 9 have been declines that are similar to what we already experienced. Also, what we find is that prices lead fundamentals. And so last year, the market was down. This year, earnings are down. And historically, whenever earnings have been down, the market has been up in anticipation of the earnings recovery in the year after. And we're forecasting about an 11.6% rise in S&P 500 earnings in 2024.
So let's talk a little bit about interest rates and what you're anticipating there. I assume you think that we're closer to the end of this rate tightening cycle than we are to the beginning. How would you handicap the possibility that tomorrow may be the last turn of the screw before a period of pause and then maybe a loosening cycle?
Hey, Tyler, good to talk to you again. Yes, we do think that the Fed will likely raise rates by 25 basis points tomorrow. It probably could be their last rate hike for this tightening cycle, although they're not going to admit that. I think they're going to continue to talk tough because they want to affirm that they are data dependent, and they will make that decision based on future data. But let's face it, the Fed is aiming at a target that's below the horizon. They don't want to overshoot the target. And also history tells us that the Fed starts to cut interest rates fewer than 9 months after the last rate hike. So I think that there is a possibility. History points to a more than 13% advance in that 9-month period going back to 1990 with all styles, all sectors, and all sizes within the S&P 1500 posting advances.